Good afternoon. Thank you for joining us for today's webinar, New Decision, New Tactics, What the Wayfair Ruling on Sales Tax Means for You. I'm Bob Sharon, partner and leader of Friedman's Tax Practice, and I'm pleased to introduce you to today's presenters. Tom Corey is a principal at Friedman and director of the firm's state and local tax group. He has more than 25 years of experience. Tom has worked with clients in a broad array of industries and advises high net worth individuals with respect to both their personal and business state and local tax matters. Also presenting is Alan Goldenberg, principal and a member of the state and local tax and tax controversy groups. He focuses on tax transactions, including structuring, advisory tax services, and tax controversies. Alan has more than 10 years of experience representing taxpayers before the IRS and local tax authorities. Friedman is a leading provider of accounting, tax, business, and consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry in all regions where we operate. Friedman's State and Local Tax Services Group is dedicated to helping clients avoid pitfalls and maximize their tax position in light of widespread tax changes. We are pleased to bring you programs such as today's Wayfair webinar, and will continue to share insights to help you navigate the complex and evolving tax landscape. The goal of today's program is to help you understand the key implications of the recent Wayfair decision, current state economic nexus rules, unanswered questions, and steps your business should take to ensure compliance. At the conclusion of the webinar, we will attend to questions from our listeners. You can submit your questions and communicate with us throughout the course of the webinar using the Q&A feature on the lower portion of your screen. We would also be delighted to speak with you on a one-on-one basis to better guide you on your particular situation. At this time, I'm pleased to turn the presentation over to my colleague, Tom Corey, who will kick off the program.
Thank you, Bob, and welcome everyone who's listening to the Wayfair webinar. Wayfair is a decision that came down from the Supreme Court in June of this year. Basically, the decision was written by now retired Justice Kennedy, and obviously the main factor regarding Wayfair is it, to a great extent, overturned the physical presence standard that had previously been imposed with respect to sales and use tax collection and nexus responsibilities. Now we're in an economic type nexus situation with respect to sales tax, and the states are continuing to expand and implement new nexus rules regarding their freedom to do so after the Wayfair decision. Many of the states have rules already in place. Certain of them have not started implementing them yet. Others have yet to impose legislation. And I shouldn't just note at the very beginning, the implications of Wayfair go beyond e-commerce. They also apply to existing bricks and mortar historical type businesses that sell interstate. That situation, you again will have new nexus rules being applied to interstate sales. Now, to give you a little bit of a broader background on this is my colleague, Alan Goldenberg.
Thank you, Tom. To set the stage for the Wayfair decision, it's important to understand the context by which sales tax nexus has been applied by the Supreme Court for really over the last 50 years. The first case that really dealt with sales tax nexus was a 1960 Supreme Court case of Scripto. And in that case, the Supreme Court ruled that independent sales representatives in a state is enough to give an out-of-state retailer nexus for sales tax purposes. That ruling was upheld in a 1967 case of National Bell Test. That is the famous case by which the Supreme Court issued the physical presence standard for sales tax nexus requirements. So there was a gradual evolution in the Supreme Court whereby out-of-state retailers, in order to be obligated to meet the sales tax rules of a taxing jurisdiction, needed to have some sort of physical in-state presence, boots on the ground, so to speak, in order to be obligated with those sales tax rules. In 1992, the Supreme Court in Quill affirmed the physical presence standard. In that case, an Illinois office supplier sent computer disks which contained inventory information to customers in North Dakota. North Dakota tried imposing its sales tax rules and obligations on the Illinois company. And in that Supreme Court case, the court ruled that physical presence was required. The Supreme Court said that the disks that were sent into North Dakota was not enough of a presence to enable North Dakota to impose sales tax on the Illinois company.
Alan, what's important to remember here about National Bell Hess and Quill is that Quill basically narrowed the nexus field regarding sales and use tax. Quill said you do not have a problem with due process. National Bell Hess had said that you've got a problem with due process clause and also regarding the dormant commerce clause. Quill basically said the due process clause is no longer a bar, but clearly, under our view, the dormant commerce clause does still pose a bar.
And that was the law of the land, so to speak, until June. But what opened the door to that was a 1994 concurring opinion by Justice Kennedy, the same Justice Kennedy who wrote the Wayfair decision. And in the DMA case, a case with regard to a Colorado law requiring out-of-state sellers to notify the state of sales into the state. In that case, Justice Kennedy put forth the opinion that the old Quill and National Bell Test physical presence standard was likely something that needed to be reviewed in light of the current economic time. So what's happened over time is that states, in order to impose its sales tax on companies that don't have a physical in-state presence, have expanded their sales tax rules to more of a virtual nexus presence. The first state to do that was New York, and that was in response to Amazon. New York put forth a click-through nexus rule whereby an in-state retailer that had a contractual relationship with Amazon, you can link through to Amazon's website to purchase goods, that New York deemed was enough of a connection to impose its sales tax on any transactions done through Amazon. Another virtual nexus law that was put forth was the cookie and app nexus by Massachusetts and Ohio. We talked just before about the notification requirement. That's really more of a use tax requirement by Colorado. Let's see listed here. But ultimately, where this all led to was the South Dakota and Alabama provisions that were challenged in the Wayfair case. And that really was the states putting forth a sales or a transaction threshold whereby if exceeded, an out-of-state retailer would be determined to have in-state nexus.
I think what's important here is to realize that the states under Quill were trying to manufacture some form of physical presence. New York started with the click-through Nexus. It moved on to the cookie and app Nexus. Under Colorado's notification requirement, there was a feeling by the court that it wasn't actually, since under that statute, the out-of-state retailer was obligated to either submit to Nexus or to provide the Colorado Division of Taxation with the, information regarding their sales and who they sold to, so that it would make it easier for the department to go after those in-state buyers with respect to use tax. As Alan said, all of this led ultimately to Alabama and South Dakota imposing either regulations or statutes that applied economic nexus statutes in which, thresholds rather, in which there was no physical presence required to trigger a filing requirement. As far as I can recall, in the state and local tax area, this is the only time that I've seen in, it's almost 30 years now, where the states have gone directly in contravention of a United States Supreme Court holding. Alan, do you remember anything like that?
No, and that's why this was pretty ground-shaking, certainly in the state and local tax world. For more of an in-depth look into the South Dakota statute, the statute that was enacted in 2016 basically stated that out-of-state retailers that did not have a physical presence in the state still had Nexus or was able to establish Nexus should they either have $100,000 of sales of product into South Dakota or 200 or more individual transactions into the state. Now, that applied to both retailers as well as wholesalers. Typically, wholesalers are exempt from sales tax because of a resale exemption. All states have what's called a resale exemption, whereby a sale from a distributor to a wholesaler is exempt on the account that the wholesaler will end up reselling the merchandise to finally the ultimate customer or to another retailer who will sell to an individual customer. That would exempt the sale. Nevertheless, that exemption has to be claimed by the wholesaler or the distributor on their sales tax filing of a return within the state. So basically, South Dakota stated that if you met either of these thresholds, the out-of-state retailer or the out-of-state seller, wholesaler, would be subject to its state sales tax rules. Now, the reason that this was important for South Dakota is that South Dakota is one of 7 states that does not have an income tax. So they had a tremendous loss of revenue. They're estimating close to some $50 million a year of lost sales tax revenue for the state. That accounts for more than 60% of the state's budget. So it was really imperative on South Dakota to try to go after these out-of-state sellers to even the playing field for brick and mortar stores that are located in the state, as well as bring in revenue into the state's coffers. Realizing that the South Dakota case was in direct opposition to Quill and National Ballot Test, the statute itself in South Dakota provided for an expeditious review process. It fast-tracked the case to any challenge to that rule so as to quickly get the case ultimately before the Supreme Court. 2 very important things about the law is that it only applied prospectively. So while the state could try to enforce the law on an out-of-state retailer, ultimately no assessment would become finalized until the Supreme Court or the highest court overlooking the case or reviewing the case would ultimately decide on the case itself. The second aspect, and really related, is that any assessments, as I said, that would have been assessed on this would be stayed until all challenges or appeals to the matter were ultimately decided. So in order to move the case along, South Dakota went after the big shop online retailers, knowing that they were going to appeal this case. So the first online retailer that they went after is Wayfair. They're located in Boston. They had no physical presence in South Dakota, yet because they exceeded the $100,000 of sales thresholds and had more than 200 individual transactions into South Dakota, the Nexus rules would apply to them. Ultimately, the case was accepted by the Supreme Court, which led to its decision in June. In a 5-4 decision, Justice Kennedy ruled in favor of the South Dakota statute, determining that it was okay for the state to apply its sales tax laws, even though Wayfair and other online retailers did not have physical presence in the state. What the justices and the majority ruled is that Quill, as it was requiring physical presence, was no longer workable, was unreliable in today's e-commerce environment.
I think it's important to remember that if you looked at the original Quill decision and with respect to the Commerce Clause concerns, expressed by the Supremes in that decision, was that because the extreme number of taxing jurisdictions for sales and use tax purposes that existed at that time and still exists today, but the Quill decision was in the early 1990s, the imposition that would be imposed on businesses by trying to keep track of all these sales and filing the returns would be just too much. It would impose basically a burden on commerce that the Supremes at that time did not think should be imposed. Since that time, Alan, and we've seen the development of a lot of computerized sales and use tax programs. We've got the sales tax simplification systems that we've got going now. Many states are in that program, and when Justice Kennedy looked at this in the Wayfair decision, that was certainly something that was considered in terms of simplifying and lifting to a great extent the burdens that exist on a business to keep in compliance currently.
Right, and that ultimately was the foundation for Justice Kennedy's opinion. That's what he certainly relied on, realizing that a physical presence no longer should be the marker for a state to be able to impose its sales tax rules. Interestingly, what Justice Kennedy did not do, in his opinion, he did not rule that the threshold in the South Dakota statute were the given statute, so to speak, or the given threshold. That the court did not rule on the constitutionality of. So we don't know if the $100,000 threshold is the minimum, or the 200 individual transactions is the bare minimum with which a state can enforce its sales tax rules. And that's important because it by not addressing that issue, it's allowed states to come up with its own standards with regard to its own virtual nexus or economic nexus standards using this methodology, and that certainly is something that could be ripe for challenge down the road.
Another important factor that the Wayfair decision did not address because it wasn't presented. The Supreme Court historically doesn't address issues that are not presented under the fact pattern that it's reviewing, was since the South Dakota law would only be imposed and applied on a prospective basis, not a retroactive basis. The court did not rule on that point. It was noted in the opinion, if you read it, and Justice Kennedy said, that might be something that could be a problem in the future, but they don't have to, rule on that at this point in time, given the current statutes that South Dakota had on its books. If we've got situations, and we certainly have seen certain situations, where states are going to announce that they're going to be looking retroactively back at some of the past sales, it could be an issue that's out there.
I agree. What the decision did do is that it did affirm the prongs in the complete auto case, the 1997 Supreme Court case, interestingly enough, an income tax case. But what the court basically mandated is that the prongs set forth under the complete auto case, the substantial nexus prong test, the non-discrimination test, the fair apportionment test, and the fair relationship between the service and the state, those prongs appear now to be the basis under which a state can develop its new taxing rules. So as long as those tests are adhered to, as long as those tests are met, any type of law or provision that a state put forth would be constitutional. So what were some of the flaws addressed by the majority decision in Wayfair of the old Quill decision in 1992? The first that the court addressed was the fact that the physical presence is not necessary under substantial nexus. It's not one of the four prongs of the complete auto test, and therefore there really was no basis for this arbitrary rule. The second is that Justice Kennedy explained that Quill actually created market disputes, whereby there was planning and other strategies that retailers were attempting to do in order to avoid physical in-state presence, and that obviously created some rather upset taxing states. And finally, the Quill decision was arbitrary. Why physical presence was the standard that was set forth was a question in the majority opinion, and really, again, it was an arbitrary rule that no longer seems to be applicable in the new e-commerce, virtual sales, Amazon world of today.
Well, I think while it's very good and we'll continue to kind of academically review the various aspects of the Wayfair decision and its history, I think what's important to realize is it's changed the landscape for businesses, both online businesses and standard historical bricks and mortar businesses that sell products through multiple states, with respect to whether there's a physical presence needed or not. Now we know there is not. We've opened the door for states to impose economic type nexus statutes on out-of-state businesses with no physical presence in the particular state. The various states have taken different positions on this. I think we've got a chart included in our printout here about the legislation that's been passed already. And in many cases, you'll see that the thresholds differ from those expressed in the South Dakota statute. Some of the statutes have rather low thresholds. Pennsylvania, for instance, has a $10,000 threshold with regard to in-state sales rather, to in-state residents, being found to be enough under their statute to trigger a sales tax collection and filing responsibility. Alan, this is a lot less than either 200 transactions or $100,000.
And this goes back to what we said before about the Supreme Court not ruling on whether the $100,000 threshold was the minimum. That really left the door open for states to come up with its own, goalpost, so to speak, when it comes to this. And I think it's ripe for challenge.
Well, it's interesting that if you read the opinion, it basically says that there is, because of today's economy, because of the, you've got these online sales and use tax systems, et cetera, the burden isn't that great anymore. But when you look at how the state statutes vary and the kind of trigger points regarding Nexus for states being so different in some cases, a business is left in a situation right now where they've got to monitor sales into each different state and have to realize that while 10,000 may be enough in Pennsylvania, you need 200,000 and I'm just using this as an example, 200,000 in the state of Washington. The burdens are going to be out there, and I expect that some of the statutes that are on the books now, as states see that, hey, $10,000 hasn't been challenged, why do we have 200,000? We're going to lower our standard too. I expect to see it. That's something that we're very likely to see soon.
Yeah, and I think a lot of taxpayers are also running into issues when they're reviewing these charts that we do have here compared to their sales. When does the law trigger? Is it on their last year's sales? What happens if this year they anticipate going over? Should they register now? Or if they have a particular sale that pushes them over the threshold, does the law apply to that particular sale, or does it apply to every sale going perspective from that? So I think a lot of questions remain for taxpayers in these new statutes.
That's a good point. In other words, if you have a situation where you have, let's say, a $200,000 threshold or 200 transactions in the state, when does that take effect? In November, I've got $150,000, and I figure I'm okay. All of a sudden, I get a big order in December, and I'm now at $220,000. Well, what happens to all that previous sales tax that I should have been collecting but haven't, given the services? So we don't know some of the answers yet, and on a going forward basis, I would imagine you look to the last year's sales to figure out whether you have Nexus or you don't. But on a going forward basis, there are certainly many instances where you may have a large uptick in sales in a particular state or number of transactions into a particular state, which can cause you significant issues.
Of course, and then the next question after that is, in year two, if you've exceeded and registered and filing for sales tax in year one, what happens in year two if your in-state sales drop below the threshold? Can you stop filing?
Exactly. I think it's likely that once you have Nexus there, it's likely that the state is going to be looking to you to continue on. And this is only, based on my experience, but I think unless you have a situation where you have 3 or 4 years where the threshold is 100,000 and you're doing $10,000 worth of sales. If you have one particular year where you drop below that, to 80,000, it's problematic anyway because you're not going to know that's going to happen likely, and you would have been collecting the sales tax all along.
The ironic thing is that in the Quill decision, it seems as if Justice Kennedy specifically referred to certain safeguards that were in place to answer any of these questions, yet it's just led to more questions. That Justice Kennedy specifically referred to the fact that South Dakota had these $100,000 of sales of 200 transactions thresholds to safeguard, to not sweep up every single out-of-state retailer. Additionally, he referred to the fact that South Dakota was in the streamlined sales tax compact, which made it easier to register and to formalize across a whole slew of states where sales tax applies and those transactions where sales tax wouldn't apply.
I think it's safe to say, Alan, that there's a lot of a lot of questions that exist after the Wayfair decision that have not been answered as of yet. These questions are hanging out there, and we have very little guidance as to how they're going to be applied. We do have a situation, I think it was in Rhode Island, where they're going back into 2017. They've announced regarding the application of the Wayfair rule. They're going back retroactively. I think one of the things that we want to talk about a little bit is what can a business do now when they find themselves in a situation where they previously may not have had Nexus from their perspective in 1 or 2 or 3 states, and all of a sudden they find they may have a filing obligation in 20 or 30 states. I think you really need to monitor the state laws and realize that this is not a one-time shot. You're basically going to have to look at these laws every year to see, as I mentioned earlier, whether they've changed the economic nexus thresholds. Is it now 100 transactions instead of 200? Is it now, $20,000 instead of $100,000? Each year, you're going to have to refresh your research in that regard. You're going to have to keep track of the number of transactions you have in each state, and also the volume of transactions that you're having in each state. Alan?
Yes, Tom, I think what will really be a good resource for all of those listening is the chart that we've included in our slides here. I think the first order of business for retailers and wholesalers and brick and mortar stores is really compare their last year's sales tax records with the list that's here. Obviously, this list is evolving. We put together these slides, and of course, just over the weekend, West Virginia, for example, came out with its new Wayfair standards. Again, the same $100,000 and 200 individual transactions. So this list is constantly being updated as we go. But I think that the first order of business is really to compare your annual sales by state to this list, see where the problematic states are, either those states where you've exceeded thresholds or those states where you're getting close to those thresholds. And really, based upon that analysis, you can determine if you do have any exposure, if you do have possible issues going forward with compliance in these other states. Similarly, if you see a state has a $100,000 threshold, and last year your sales were 90 or 95,000, it may be safe to assume that in the coming year you may exceed that threshold. So those are states you want to take with a little more look at a little more closely in the coming year to evaluate whether you exceed that threshold and at which point there would be a collection requirement.
Yeah, I think that there's going to be a very, very significant burden, particularly on smaller and startup businesses regarding this new sales and use tax, economic nexus thresholds. Obviously, the use of a computerized sales and use tax system will lessen that burden, but I don't think it can be understated by saying, the economy has changed. We're more into an internet, economy. I think smaller and startup businesses are going to have to expect that they are going to be potentially subject to audit, that they're going to have to keep, very close watch on their thresholds, that they're going to have to keep very good records, that if in fact we're talking about, wholesalers that are depending on resale certificates and that type of thing to avoid taxation, they're going to have very, very good records in that regard, because should they be audited and they can't produce them, they're going to have issues. I don't think we can minimize this is going to be a burden on businesses going forward.
And a large expense to purchase or to lease the software, license software. Everybody thinks technology makes things easier, but certainly comes with an added expense. The other question we're getting a lot of is how this impacts taxpayers' corporate nexus, and whether filing a sales tax return in a state that they do exceed these thresholds will trigger, income tax requirements as well. And while I don't think that necessarily is the case, though some states do have economic nexus standards for corporate income tax nexus, I think it's likely to see some states be aggressive with respect to this, and certainly to start, receiving notices about, possible income tax liabilities.
Of course, we do have, and just very quickly, we do have Public Law 86-272 regarding protection of sales into states where you only got solicitation as an in-state activity from an income tax perspective, but there are certain states do not apply income taxes. Similarly, Washington, the state of Washington has the B&O tax and other things. So I think we have an evolving area that still has to be reviewed, and there could be a lot of issues coming out of that. Right now, this is kind of the time we're going to set aside. We've completed kind of our presentation. We've set aside some time to answer questions. If anyone has any, we've had some come in already. If we have any additional questions that people want to submit now, we'll try to get to them as much as possible. And if you have any individual circumstances that you would like us to review, we're happy to set up separate conferences with you about that. Thank you so much. Okay, we've got one question to come in. It's a good question. Basically, you've got a situation where you've got an order coming in from a customer that includes a number of different items. They may ship in different boxes. And, in essence, 2 or 3 pieces, generating multiple invoices. For transaction count, do we count that as one item or multiple items? I would think if we're talking about one order, it's probably going to be seen as one item. On the other hand, if someone calls you in, even though you may have multiple invoices, frankly, you may have a situation where certain things are subject to tax and certain things aren't subject to tax, and sometimes, you need different invoices along that way. But I think if you have purchase orders, in other words, that are out there that are, someone calls you up with one item for one item one day, and then calls you up for another item another day, and you send both items in the same box, I think in that case you might have 2 different transactions. So it goes both ways. It's a good question though, and there isn't a whole lot out there on it, but that's my take on it.
So we had a question that came in and was asking of how does the Wayfair affect existing brick and mortar businesses? And as Tom mentioned earlier in the presentation, the law does apply, or these laws do apply to brick and mortar stores as well as online retailers. And how would it apply to brick and mortar stores? Well, the situation is like this. You have say a furniture store located in Connecticut. There are only stores in Connecticut, and say Connecticut has a Wayfair statute. Customers from New York drive across the state border, purchase furniture from the store, and then the store ships the furniture via third-party carrier to the customer located in New York. If that happens enough, if that exceeds the Connecticut thresholds, assuming Connecticut has those types of standards, that's how the Wayfair rule could apply to brick and mortar store as well. That would require the brick and mortar store to have to file, sales tax returns, say in New York or Connecticut, wherever that customer, where those sales may be.
Here's an interesting question that we've got. Basically, the question is, how do you think the economic nexus thresholds, monetary thresholds, will interact with sales and use tax exemption, such as sales tax holidays that are common in southern states, or hurricane preparedness, or back to school exemptions for clothing and food items? I personally, and again, this is not based on my guidance, but any guidance rather, I think that those would be counted. So that if I've got because there's nothing in the statute that says that the $100,000 has to be with respect to taxable transactions. It just says that there has to be $100,000 of sales into a particular state. So in my opinion, I think even if the sales would qualify as exempt sales, they would fall under within the qualifying thresholds.
Another good question that came in is discussing whether Congress may introduce something or they would take some sort of action with respect to this. And that's certainly something that's out there. There's been some discussion about implementing a national law on this, certainly more to standardize sales tax rules. We know that there are over 7,000, by some estimates, 10,000 different sales tax rules across the country, which obviously makes compliance rather burdensome. So it is possible. There has been a lot of talk out there about this. One of the ways some states have actually tried to streamline the Wayfair law is to impose the sales tax on marketplace facilitators. So instead of, for example, charging third-party retailers on Amazon with the task of charging sales tax, they will shift the burden onto Amazon to charge sales tax on those third-party sales, so as a way to ensure compliance.
Great, Alan. There's another interesting question that came in. Filing in different states basically requires setting up a sales tax payment account. Obviously, that can be involved, including deposits, prepayments, etc. How will a small business handle this workload? That's a really good question. It's going to be extremely burdensome on these small businesses, which is what I alluded to before. I think the impact is going to be very, very significant and could put, frankly, some of the small businesses at risk, certainly on an ongoing basis. And obviously, if they ignore their sales tax responsibilities, something that could be something that could be extremely problematic because, should they be audited? One thing I should mention about sales tax, I'm sure many of you know it, is a concept called responsible party liability in the case of sales tax, which can, in essence, impose personal liability. I want to repeat that: personal liability on certain business owners and folks that work for them that have a responsibility for filing sales and use tax returns, putting their personal assets at risk should the sales and use tax not be collected from the original purchaser. Something very seriously to be considered.
Another question here came in is with respect to local sales tax. Many states have a state sales tax, but a number of jurisdictions also have local sales tax. And the question is, what's the applicability of the local sales tax in those states that have enacted or enforcing a Wayfair rule? And ultimately, these sales tax rules are typically done at the state level. So the local sales tax rates would similarly apply to any sales. So when you're selling to a particular jurisdiction, the address of where the customer is located is certainly important when applying the sales tax rate.
Yeah, as an example, I don't recall the totally number of localities in New York, but I think New York State has something like, let's say, 40 localities that impose their own tax. The New York sales and use tax itself is only 4%. When you consider that the tax rate in New York City is 8 7/8%, it's a significantly higher burden. When you have a number of localities, which New York is not unique in that way, keeping track of where the sales are going to and imposing the appropriate rate of tax is very, very significant and burdensome.
Got another question here regarding foreign retailers and how Wayfair would impact those types of businesses. And it seems likely that retailers or product sellers from outside the country that are selling into the U.S. into a state that does have a Wayfair type statute will also be subject to the sales tax rules. How the state will be able to enforce its sales tax obligations on those foreign retailers is a conundrum for the state. But nevertheless, these rules apply to both U.S. as well as foreign retailers.
Interesting question here. It's a little bit complex. How will a small business know if they are going to go over the threshold in certain states in the future when they're selling everywhere? Should they just collect all sales tax in all states just in case they exceed thresholds? Could they then refund the collected tax to the purchases at the end of the year? Would they be required to refund it or submit it to the state? I think it's kind of a slippery slope here. In essence, the purchaser is assuming they are a resident of New York. If a New York resident purchases an out-of-state item that they don't pay sales tax on, they are responsible for paying use tax to the state. Now, the situation where you're collecting tax and then going to refund it, that's probably not going to work. Certainly in the case where you have a small business. If you collect tax and don't submit it to the state and don't refund it, in essence, that could be a situation where you could get yourself in a lot of trouble. So I think that the best way to do it, if you're going to follow that route, if you are going to collect the tax kind of voluntarily, if you don't know about it, is to submit it to the state.
Right. I think just best practice is for businesses to utilize the charts that we put out here in our slides and to use that as a reference point. Obviously, I would think additional states are going to start putting out other provisions, and that's something to keep a close eye on. But nevertheless, I think that's really the first step to compliance is to look at these particular states first.
I've gotten several questions here regarding, computerized programs and what the impact of Wayfair is. I think, and I'm not gonna talk about specific programs now. If someone has an interest in, my view regarding the sales and use tax computerized program, I'm happy to talk to them individually. But I do think that obviously Wayfair and the burdens that it puts on small and operating businesses is tremendous. And I think it is kind of going to be a big push forward for computerized businesses. I'm sure the folks that do operate in the computerized sales and use tax compliance area are getting a lot of interest after the Wayfair decision.
We've been getting some questions here regarding companies that do have Nexus by virtue of Wayfair, whether they're obligated to register with the state to do business or obtain a business license with a particular state. And I think a strong argument could be made against registering. And the reason being is that the out-of-state company is really not operating in the state. Typically, business registrations, particularly with a Secretary of State, is more for due process. In case of a lawsuit, you're trying to sue somebody in the state, you need to be registered in a state. But I think a strong argument can be made against the need to register. And as of right now, I think we can avoid that requirement.
One additional thing, sometimes certain states take positions that when you register to do business in their state, you automatically subject yourself to income tax nexus, which is something, you may not normally have to face if we're just going with basically Wayfair sales and use tax nexus. One question, what if a company does not realize it needs to collect tax? Well, unfortunately, ignorance of the fact of the need to collect tax is not, I've never seen it really work in an audit situation. You have a situation where when you go into business, you're obligated to know the laws with respect to sales and use tax collection responsibilities. And if you don't follow those laws, as I said before, you could find yourself in a situation where there's personal liability involved. And one of the reasons that happens, it happens with payroll taxes also, is as a vendor, you are acting in a trustee capacity with respect to the taxes that you're collecting and remitting to the state. They are imposed on your customers generally, and not on you, but you have an obligation to collect them and transfer them to the state. As a result, in those situations, you've got this responsible party liability that arises.
Tom, I think an important thing to point out on this is the fact that states have voluntary compliance programs, whereby taxpayers that are not in compliance with their tax obligations oftentimes can apply to the respective departments of revenue of the state and be able to enter a program whereby back years of tax can be filed. Typically, states will limit that look-back period to 3 to 4 years. But one of the benefits of the program is that usually the state will agree not to audit those back years and will abate any penalties on tax that's owed. One of the big things when it comes to sales tax that's important to remember is that sales tax really should never come out of a retailer's pocket. The sales tax is really owed by the ultimate customer, and it's the obligation on the ultimate customer to pay the tax or the use tax. So the worst case scenario is when a company gets audited for not charging sales tax and has to dip into its own reserves to pay a tax that again should never really come from their finances at the first place. So compliance from the outset is most important. But if you do find that you do have Nexus in a particular state and haven't been filing, whether it's under Wayfair or physical presence or any other type of Nexus standard, a voluntary disclosure process is a good option.
Good point, Alan. The important thing to remember about voluntary disclosure is that you can't have been found by the state already. In essence, if the state has sent you a notice or, they're in many cases have sent you a Nexus questionnaire and have, located you or come up with some questions for you, frankly, usually all bets are off with respect to voluntary disclosure. Voluntary disclosure means, you realize that you had been, selling into the state, you have exceeded the thresholds, you have not basically filed the returns that you should have been filing, and then you go forward and disclose to the state. Unfortunately, in many cases, when you do voluntary disclosure, and certainly in the sales and use tax area, as Alan has mentioned, you're going to have to dip into your own pockets because by that time, you're not going to be able to go back and collect the tax from the customer.
Yeah, that usually doesn't work out well for companies.
I think at this point in time, any additional questions that folks have, we're certainly willing to discuss them with you, or if you want to send us an email, I think our email addresses are on the presentation. We've enjoyed giving you our insights regarding Wayfair, and we thank you very much for joining us for the program. Thank you and have a great day.